Hello, and welcome to ZIM Investment. This analysis is for ZIM Integrated Shipping Services on the New York Stock Exchange as of 6th of August 2026, with a share price of $26.58. The full report is on donatien.ca. ZIM is being bought for $35.00 a share in cash and trades at $26.58. That gap is not a mispricing you can arbitrage with confidence. It is the market pricing the odds that Israel refuses to let the sale happen. Start with what the share certificate actually entitles you to. In February, Hapag-Lloyd signed a binding agreement to buy ZIM outright for $35 a share in cash, valuing it at roughly $4.2 billion. This is not a rumor or an approach. Shareholders voted on it at the end of April and approved it by 97%, which closed the window for a rival to gazump it. Competition regulators are working through it in the ordinary way, and Australia's cleared it in July. The company still guides to completion in the fourth quarter, so the price you pay today is not really a judgment about container shipping at all. When Israel privatized ZIM, it kept a special share, and that share carries a veto over who ends up owning the fleet. The reasoning is not commercial. ZIM is treated as strategic infrastructure. In an emergency, the state wants to be able to call on those ships to bring in fuel and grain. In early July, the government moved against the sale. The defense minister adopted the security establishment's position that the deal as structured does not protect the national interest, and the Prime Minister said it was not on the agenda. The specific worry is that Hapag-Lloyd's own shareholders include Qatari and Saudi sovereign funds. That is the whole gap, in one sentence. This only matters if the deal dies, but if it dies, it matters a great deal. The freight boom that made ZIM extraordinary in 2024 has unwound. Revenue has fallen for 4 straight quarters and is down about 30% on the year. The company lost money last quarter, and container rates have been drifting lower for 3 consecutive weeks as tariffs bite into demand. ZIM leases rather than owns its ships, so when rates fall, it keeps paying while owners cut costs. What cushions all of this is the balance sheet. A little over half the entire market value of the company is sitting in cash, and the shares trade below book value. Be clear about the shape of the downside, because it is not gradual. If Israel says no, this does not drift lower over a fortnight and let you leave at a sensible price. A cabinet decision is announced outside market hours, and the shares reopen somewhere near $19. That is roughly a 29% loss taken in one move, through any stop you thought you had. And the compensation for wearing that risk is thinner than it looks. On the market's own assumptions, the expected gain is 0, and about 4/5 of our own modest positive number comes from a 10% branch where a rival Israeli bidder revives an offer the board has already declined to pursue. Second quarter results arrive on the 19th of August, and there will be no earnings call to explain them. Now weigh the risk against the reward. The bull case is roughly 41% above today, the base case, the most likely, about 32%, and the bear case, a fall of about 29%. So you are risking about 29 to make 41. So, our call on ZIM Integrated Shipping Services on the New York Stock Exchange, hold. Remember, this is for education, not financial advice. Always do your own research. This analysis is by ZIM Investment at donatien.ca. The link to the full report is in the notes below. Have a great day.